The Australian trade deficit widens for a third month in data out today, as falling iron ore prices and a weaker Aussie dollar take their toll. From Melbourne, I'm joined by Chief Market Analyst with IG Group, Chris Weston, to explore this data further. So Chris, disappointing figures in balance of trade out today, but not unexpected considering falling iron ore prices and the weaker Aussie dollar. Are we likely to see more data like this in the coming months?
Well, I think the big one's really now down to the 22nd of April. I mean, we've got the RBA meeting next week, and the market's giving a pretty decent probability, nearly 80% now, that we're going to get a rate cut. There's probably slight disagreement with what the economists are calling for, who are still seeing, the bulk of them are still seeing the cash rate staying at 2.25%. I think the deficit was expected to widen by probably a little bit more than what we actually saw. I'm not sure what the implications about growth is going to be here, but certainly I think that the big data point, if we don't get a rate cut next week, will clearly be the April 22nd CPI number that's going to come through. Now, I think we're going to see a fairly benign inflation number there, and that may well mark the trough in inflation in Australia, but certainly the expectations around that, if it's higher, people might say to themselves, then the RBA probably done cutting rates for the time being. If it's lower, then I think most people would probably say that there's a possibility we could see a cash rate even as low as 1.5% by year end. So for me, the big one now really derives around the inflation number that we get in late April. And then I think a lot of the stuff that we see with trade data is really going to be down to what happens in China and what happens with their import numbers there as well. So I think given that Australia is clearly a derivative of China and other regions as well, we'll be looking at some of the subsequent demand data from other countries as well.
Is there any optimism from the trade figures that show imports solidly rising?
Well, imports didn't. I don't think they rose in any kind of solid manner. Imports outpaced. I think they were up about 1% on a month. So, they're up 1.9%. So that's a gain. We'll take a gain, and the exports were up about 1%. So I don't think either of these two figures were substantial enough to really throw confidence out that the RBA are not going to cut rates. This trade data that we saw today is a bit of a road blip, to be honest. It doesn't really change anything in Australia. There's still massive vulnerabilities coming through. And to be honest, it's not really what the market's focusing on too closely that's driving the underlying currency. The main two drivers, and certainly probably about 60% of the price action, is coming from the CRB commodity index and predominantly the iron ore price at the moment. There's a very, very strong correlation between the Aussie and the iron ore price. So as long as iron ore prices head lower, then the Australian dollar is going to find the path of least resistance lower. And then the second one is yield spreads, the difference between government bonds, if you take the 10-year, for example, and the US government bonds, which I suppose does have an impact. Data does obviously clearly have an impact on that. But the spreads are clearly, the premium in Australia is clearly narrowing against that of the US. And as long as that continues to narrow, again, the Australian dollar is going to find sellers coming through pretty quickly. So, I think all paths lead to a weaker dollar for me, Australian dollar. And I think that the talking point today has not necessarily been just against the greenback, but against the Kiwi dollar. We've seen it trade to a record low today.
You said it yourself, all paths lead to a weaker dollar. The weakness of the Aussie dollar certainly wasn't helped by the data, nudging lower after the release. So are you saying we could be seeing it hit even lower levels?
Well, as I say, I think you've got to take a view. If you're a currency trader, we've got to take a view on what's going to happen with iron ore prices. And given the correlation, one thing I look as a currency trader is really what is driving currencies. And therefore we look at correlations between markets and sense check whether or not that's actually having a clear impact. And as I say, the correlation between the CRB commodity index or iron ore and the Aussie dollar is very, very high right now. And I don't think the Aussie dollar has adjusted enough to the falls that we've seen in the last month in its key export commodity. And therefore the RBA will probably favour cutting next week. I'm still sort of 50-50, but there is a why wait is the mantra that everyone's going forward. They still need the Australian dollar to adjust more closely to the terms of trade, which means a weaker number. But we need to take a view on the Aussie dollar, on the iron ore price. And if you look at the current fundamentals in the iron ore complex, you're seeing a clear surplus this year. But then you take that surplus out for a couple of years, and you're looking at something like 280 million tonnes of excess capacity. And we're not seeing that equilibrium where supply kicks in, where demand kicks in, and steel mills in China saying to themselves, these levels are so compelling, we're going to start restocking in some decent size. We're not seeing that at all yet. We're not seeing those kind of demands, and therefore, futures markets are falling, the spot price is falling with it. And, it suggests from a trend perspective, a momentum perspective, that iron ore prices can fall further. The fundamentals justify that, and the Australian dollar will probably subsequently have to continue falling, and the RBA will have to try and target a weaker currency to try and catch up with those terms of trade.
Chris Weston of IG Group joining me there. That's all from me for now. Thanks for tuning in and be sure to keep clicking back.